Hi, this is Lawrence Sanek with Castle Dream Real Estate, the company that helps sellers and buyers capture the dream in the greater Tampa, Florida area. Castle Dream Real Estate is bringing you Home Seller, Home Buyer with Home Buyer Episode 16, mortgage settlement costs, origination fees, title insurance, and more. Okay, let's get started with the mortgage settlement costs, origination fees, title insurance, and more. The mortgage settlement process, sometimes called mortgage closing, can be confusing. A settlement may involve several interested parties and a variety of documents and fees. This will help you understand the steps involved in the settlement process. Although the focus here is on settlements for home purchases, much of the guidance will also apply if you refinance a mortgage. Settlement costs can be high, so it pays to shop for settlement services and negotiate with the home seller, your mortgage lender, and your real estate attorney or settlement agent. The less you pay in settlement costs, the more funds you will have to get started in your new home. Negotiate the terms of your purchase. Customs and practices during settlement often vary regionally, with buyers and sellers free to negotiate which party pays certain fees. In slow-moving real estate markets, for example, the seller may agree to pay certain settlement costs, including points or fees usually assumed by the buyer. In fast-moving markets, the buyer may have to agree to pay more cost to close the deal as an incentive to the seller of a property in a great demand. Whatever you negotiate should be in writing and will become the basis of the sales contract. However, be careful. If some buyer's costs are shifted to the seller, the price you pay for the property may increase if the seller wants to recoup those costs. You can reduce some costs by shopping around for settlement services. The more you know about the settlement process and related costs, the better your chances are for saving money at settlement time. Because settlement costs vary significantly based on your locale, it is difficult to provide reliable estimates for costs that fit every settlement situation you may encounter. However, one rule of thumb for buyers is to figure that settlement costs will be about 3% of the price of your home. In some relatively high tax areas of the country, however, 5 or 6% may be more common. Some settlement costs, such as homeowners insurance, private mortgage insurance, or points, can be more expensive if your credit rating is low. Knowing your credit score, therefore, can help you understand how lenders will evaluate your applications and how that score may impact the cost of your mortgage loan and help you to anticipate your settlement costs. Your lender is required to give you a copy of your credit score as part of the settlement process. Make sure you get a copy of your score. Understand the types of settlement costs. Most people associate settlement costs with mortgage loan charges. These fees and charges vary, so it pays to shop around for the best combination of mortgage terms and settlement costs. Mortgage-related costs that may apply to your loan may include the following. Application fee. Imposed by your lender or broker, this charge covers the initial costs of processing your loan request and checking your credit report. Estimated cost can be $65 to $640, including the cost of the credit repair for each applicant. The median cost is about $365. Loan origination fee. The origination fee, also called underwriting fee, administrative fee, or processing fee, is charged by the lender for evaluating and preparing your mortgage loan. This fee can cover the lender's attorney's fee, document preparation costs, notary fees, and similar charges. Estimated costs $2,130 to $3,150 with a 5% down payment, $1,984 to $286 with a 10% down payment. These are all based on a home that is about $200,000. Points. Points are a one-time charge that may be negotiated with the lender, usually to reduce the interest rate you pay over the life of your loan. 1 point equals 1% of the loan amount. For example, 1 point on a $100,000 loan would be $1,000. In some cases, especially in refinancing, points can be financed by adding them to the amount that you borrow. However, if you pay the points at settlement, they are deductible on your income taxes in the year they are paid. Different deduction rules apply when you refinance or purchase a second home. In your purchase offer, you may want to negotiate with the seller to have the seller pay all or a portion of the points. The estimated costs are anywhere from 0 to 3% of the loan. Appraisal fee. Lenders want to be sure that the purchased property is worth at least as much as the loan amount. An appraisal fee pays for a determination of the value of the home and lot you want to purchase or refinance. Some lenders and brokers include the appraisal fee in the application fee. You can ask the lender for a copy of the appraisal. If you are refinancing and have a recent appraisal of the property, some lenders may waive the requirement for a new appraisal. Estimated costs are $260 some to $440. Lender required home inspection fees. Lenders may require a termite inspection and an analysis of the structural condition of the property by an engineer or consultant. In rural areas, lenders may require a septic system test, if applicable, and a water test to make sure the well and water system will maintain an adequate supply of water for the house. This is usually a test for water quantity, not quality, and your health department may require a water quality test as well, but may do so outside the settlement process and with a separate payment. Keep in mind that such inspections are to the benefit of the lender. You may want to request your own inspections to make sure the property is good and acceptable for the type of investment you are making. Estimated cost $300 to $500. Prepaid interest. Your first regular mortgage payment is usually due about 6 to 8 weeks after you settle. For example, if you settle in August, your first regular payment will be due on October 1. The October payment covers the cost of borrowing the money for the month of September. Interest costs, however, start as soon as you settle. The lender will calculate how much interest you owe for the part of the month in which you settle. For example, if you settle on August 16th, you would owe interest for 16 days, August 16th through August 31st. Estimated cost depends on the loan amount, interest rate, and number of days since settlement. For example, a $120,000 loan at 6% for 16 days, about $220. A $142,500 loan at 6% for 16 days, about $375. Private mortgage insurance. If your down payment is less than 20% of the value of the home, the lender will usually require mortgage insurance. The insurance policy covers the lender's loss if you do not make the loan payments. Typically, you will pay a PMI, private mortgage insurance, monthly along with each month's mortgage payment. Your PMI can be canceled at your request in writing when you reach 20% equity in your home based on your original purchase price. If your mortgage payments are current and you have a good payment history, by federal law, your PMI payments will automatically stop when you acquire 22% equity in your home based on the original appraised value of the house as long as your payments are current. Some lenders will pay for the LPMI or lender's private mortgage insurance and in turn charge a higher interest rate to you. Unlike the PMI that you might pay, the LPMI, there is no automatic cancellation of the insurance charge once you acquire 22%. To eliminate LPMI, you must refinance the loan, which in turn means carefully considering market interest rates and settlement costs at the time to see if refinancing would be advantageous to you, rather than keeping your current mortgage and its attendant costs. FHA, VA, and RHS fees. The Federal Housing Administration offers insured mortgage, and the Vendors Administration and the Rural Housing Service offer mortgage guarantees. If you are getting a mortgage insured by the FHA or guaranteed by the VA or RHS, you will have to pay FHA mortgage insurance premiums or VA or RHS guarantee fees. As with PMI, FHA insurance premiums will stop when you acquire 22% in equity. FHA fees are about 1.75% of the loan amount. VA guarantee fees range from 1.25 to 3.2 of the loan amount depending on the size of your down payment. The higher your down payment, the lower the fee percentage. RHS fees are 2% of the loan amount. Homeowners insurance. Your lender will require that you arrange for homeowners insurance coverage, sometimes called hazard insurance, at settlement. This insurance protects against physical damage to the house by fire, wind, vandalism, and other causes, and ensures that the lender's investment in your purchase will be secured even if the house is destroyed. If you are buying a condominium, hazard insurance may be part of your monthly condominium fee. You may also want to secure insurance coverage for your home, furnishing, and valuables. Flood determination fee. If your home is a special flood zone area where flood insurance is mandated, lenders cannot offer you a mortgage loan unless you buy flood insurance. Regardless, your lender may charge a fee to find out whether the home is in a flood hazard area. Flood insurance protects the lender if flooding damages or destroys the home. Escrow. Some lenders require that you set aside money in an escrow or reserve account to pay for property taxes, homeowner insurance, and flood insurance if applicable. Lenders use escrow funds to ensure that these items and expenses are paid on time and to protect their interest on your home. With an escrow account, Money is held by the lender or its agent, which then pays the taxes and insurance bills when they are due. At settlement, you may need to provide funds for this account depending on when payments will be due. For example, if you buy your home in August and property taxes are due the following January, you will need to deposit funds into the escrow account at settlement so that you can cover tax payments when they are due in January. Property survey costs. Lenders require a property survey to confirm the location of buildings and improvements on the land you are purchasing. Some lenders require a complete and more costly survey to ensure that the house and other structures are legally where you and the seller say they are. Other miscellaneous settlement costs. Depending upon the location and type of property purchased and the extra settlement services you or the lender request, you may also have to pay some of the following fees and assessments. An assumption fee. If you are assuming or taking over an existing mortgage, the lender may charge a fee. Prorated expenses between the seller and buyer. In your purchase contract, you may agree to split some costs with the seller to cover your respective periods of ownership during the overarching calendar year or tax period, such as prorated property taxes. Some of these expenses may involve large amounts. For an example, annual condominium fees, homeowners associations, water bills, and other lump sum service charges. Inspection costs and fees. As a buyer, if you make your purchase offer contingent on results of a home inspection, such as testing for structural damage, water quality, and radon gas emissions, you will have to pay for these inspections. Escrow account funds. In the purchase contract, you can request that the seller set up an escrow account to cover any costs for repairs, radon mitigation, house painting, or other items. For example, if you do not test all the appliances, for instance, if you buy in the summer, you may not test the furnace. You may request an escrow account to cover repairs if they are needed in the future. The seller may agree to split the costs with you, in which case you would need these funds at settlement. Sellers sometimes offer home warranties in lieu of these arrangements and as an enticement to buyers. These warranties typically cover repairs or replacement of plumbing, heating, major appliances, and other systems not covered by other home insurance policies. Fees paid to find a lender. As a borrower and buyer, you may work with a mortgage broker or third party to secure a mortgage loan. For example, you may want to work with a broker to find a loan with non-standard terms and conditions. Brokers arrange transactions rather than lend money directly. In other words, they find a lender for you. Brokers will generally contact several lenders regarding your application, but they are not obligated to find the best deal for you unless they have contracted with you to act as your agent. Learn about charges to establish and transfer ownership. Title search. The goal of the title search is to assure you and your lender that the seller is the legal owner of the property and that there are no outstanding claims or liens against the property that you are buying. The title search may be performed by a lawyer, an escrow or title company, or other specialist. Title searches can be time and labor intensive. Public real estate records can be spread among several local governments, including surveyors, county court, tax assessors, and recorders of deeds. Liens, records of death, divorces, court judgments, and contests over wills, all of which can affect ownership rights, must also be examined. If real estate records are computerized, the title search can be completed fairly quickly. In some cases, however, the title search may involve visiting courthouses and examining other public records and files, which is more time-consuming. Title insurance. Most lenders require a title insurance policy to protect the lender against an error in the results of the title search. If a problem arises, the insurance covers the lender's investment in your mortgage. The cost of the policy, a one-time premium, is usually based on the loan amount and is often paid by the buyer. However, you may negotiate with the seller to pay all or part of the premium. The title insurance required by the lender protects only the lender. To protect yourself against title problems, you may want to buy an owner's title policy. Normally, the additional premium cost is based on the cost of the lender's policy, but it can vary based on your locale. Some advice on keeping title insurance costs low. If the house you are buying was owned by the seller for only a few years, check with the seller's title company. You may be able to get a reissue rate because the time between title searches was short. As well, if you are refinancing, you may be able to get a reissue rate on your title insurance. The premium is likely to be lower than the regular rate for a new policy. If no claims have been made against the title since the previous title search was done, the insurer may consider the property to be a lower insurance risk. Usually you will have to buy title insurance from a company acceptable to your lender. However, you can still shop around for the best premium rates, which can vary depending on how much competition there is in the market. If you decide to buy an owner's title policy, look for one with as few exclusions from coverage as possible. Exclusions are listed in each policy, and if a policy has many exclusions, that is, situations under which the insurer will not pay for your title problems, you may end up with little to scant coverage. Settlement companies and other settlement agents. Settlements are conducted by title insurance companies, real estate brokers, lending institutions, escrow companies, or attorneys. In most cases, the settlement agent provides a service to the lender, and you may be required to pay for these services. You can also hire your own attorney to represent you at all stages of the transaction, including settlement. In some regions, all parties involved in the sale, the buyer, the seller, the lender, the real estate agents, attorneys for the buyer, seller, and lender, and representatives from the title firm may meet to sign forms and transfer funds. In other regions, settlement is handled by a title or escrow firm which collects all the funding, paperwork, and signatures and makes the necessary disbursements. This firm delivers the check to the seller and the house keys to you. Consider state and local government fees and taxes. In some parts of the country, transfer and recording fees are low. In other parts of the country, costs of transfer fees, recording fees, and property taxes collected by the local and state governments may be as much as 3% of the loan amount. Some of these fees, such as the recording fee and transfer fee, are one-time fees. Although there is no way to avoid paying these fees and taxes, you may be able to negotiate with the seller to assume some of these costs. But remember, you must include these terms in the purchase offer for the property. Funds to cover property taxes may go into an escrow account. The amount you will need depends on when property taxes are due and the timing of the settlement. The lender should be able to give you an approximation of these costs at the time you apply for your mortgage. Understand all-in-one pricing of settlement costs. Some lenders have bundled most of their settlement costs into a single price. Generally, bundled arrangements combine the following fees: application origination, underwriting and processing, points, pest inspection, appraisal, credit reports, lender's attorney, flood certification, title search, and title insurance recording and fees for other services. This all-in-one price, however, does not include all of the fees charged at settlement. You will also need funds for the following: prepaid interest based on the day of the month you settle, mortgage and transfer taxes determined by your state or local taxing agency, private mortgage insurance if needed, homeowners or hazard insurance if needed, and reserve or escrow funds for the property taxes and homeowners insurance. Ask for estimates of settlement costs. At various points in the loan application process, you are entitled to estimates of the costs and fees associated with your mortgage and completing the settlement process. The good faith estimate, also known as GFE. With such a long list of potential charges at settlement, it is important to know which ones will apply to your purchase. The Real Estate Settlement Procedures Act, known as RESPA, requires your mortgage lender to give you a good faith estimate of all your expected closing costs within 3 business days of the submission of your loan package, whether you are purchasing or refinancing the home. Although called a good faith estimate, it is important to note that your actual expenses at closing may be somewhat different. The standard good faith estimate form lists which costs will change prior to settlement and the maximum amount by which they are allowed to change. If you are purchasing the home, a booklet provided your broker and mortgage lender, Buying Your Home, Settlement Costs and Help Information, explains the role of good faith in the settlement process. Truth in lending information. For home purchases, the lender is required under the Truth in Lending Act to provide a statement containing good faith estimates of the cost of the loan within 3 business days after receiving your application. This estimate will include your total finance charge and the annual percentage rate, also known as APR. The annual percentage rate expresses the cost of your loan as an annual rate. This rate is likely to be higher than the stated contract interest rate on your mortgage because it takes into account discount points, mortgage insurance, and other fees that can be added to the cost of your loan. When refinancing your mortgage, you will receive truth in lending disclosures before you settle. Until you receive those disclosures, the creditor and other parties cannot charge you fees related to your loan application except for a fee for obtaining your credit history. HUD-1, HUD-1A. When you purchase a home or refinance your mortgage, RESPA also requires the lender to give you a copy of the HUD-1 or HUD-1A settlement statement the day before you go to settlement. If you request it, this settlement statement of settlement costs will show all the fees and charges you will be expected to pay at settlement. The HUD-1 also states the initial terms of the loan, including the monthly amount due. The revised HUD-1 is designed for easy comparison with your good faith estimate. Most costs in the 800 to 1300 series of the HUD-1 form are labeled with the corresponding section of the good faith estimate for reference. Included in the HUD-1 are comparison charts for the estimated costs provided on the good faith estimate and actual cost paid at closing. These will be completed by the settlement agent for you before closing with information provided by your lender. Fees paid outside of settlement closing. Sometimes fees may be listed on the HUD and marked POC, paid outside of closing. You will pay some of these fees, such as for credit reports and appraisals, before settlement. Other fees, such as your direct payments to a mortgage broker, you will pay at settlement. Payments by other parties, for example, from the lender to the mortgage broker, also may be marked POC, paid outside of closing. Because costs vary from one area to another and from one lender to lender, we have included an example of an estimate only on our website. The example is based on a $200,000 home with a 5% or 20% down payment. Excluding reserves for property taxes and down payment, settlement costs for the 5% down payment loan vary between $6,235 and $19,930. Settlement costs for the 20% down loan payment vary between $5,800 and $18,440. Your cost may be higher or lower than the examples provided. Just remember, all figures are estimated and the good faith estimate from the lender or title company are those that will apply. Again, go to our website, homesellerhomebuyer.com, look at Homebuyer episode 16, and we will have the show notes there as well as this example of a settlement sheet. Thank you for listening to Home Seller Home Buyer with Homebuyer Episode 16, Mortgage Settlement Cost, Origination Fees, Title Insurance, and more. We're grateful for the time you take to listen to this podcast, and it wouldn't be there if it wasn't for you. We look forward to your input and what you would like to hear about in future podcasts. You can find the show notes at homesellerhomebuyer.com, and you can leave your comments, questions, and suggestions there, or you can email us at info@homesellerhomebuyer.com. Don't forget to contact Castle Dream Real Estate at info@castledreamrealestate.com so you can capture the dream of buying or selling property in the greater Tampa, Florida area from Spring Hill to Sarasota. Tell your family, friends, and coworkers about Home Seller Home Buyer. Thank you for taking the time out of your busy day to listen to Home Seller Home Buyer and catch us on the next episode. Thank you for listening and stay informed.